So let's see how this volatility kicks in, but how do you brace yourself for the markets? Let's understand that from Abhay Agarwal, who is joining us on the show right now. Hi Abhay, good to be speaking with you. First up, help us with your take on the markets, because seems like that the market is seen to be climbing the wall of worry with respect to tariffs, lower earnings growth. But help us understand that is this a temporary bounce back or a dead cat bounce is what you are seeing? Or you believe that the valuations are much more attractive right now and this is the time where you go ahead and chip in some money?
Yeah, good afternoon. So I think if we just take a step back on the markets part, what we saw was that as soon as Trump won the elections, there was a one-way sharp rally in the US dollar index, almost 9%, which was unprecedented. Even in the last presidency of Trump, the US dollar strengthened by only 3%. Now, what that meant is that with his tariff threats, the market was already anticipating the US global markets that there will be higher inflation in the US because of tariffs, which means that there will be no rate cuts, and higher bond yields further took up the US dollar, and that created a perfect storm for the Indian stocks. Because what we saw is that heavy FPI selling, a lot of money going back to the US to benefit from high yields in the US and the high and then the strong US dollar. Now, some of that is reversing. And for India, it was a bigger problem because we came in January, the quarterly results were below par, gave another reason for investors to sell. But I think a lot of it is now settling down. We're seeing a fall in US dollar. We're seeing a fall in US dollar yields now. There is no fear that yields will spike further. And what that means is that I think we are seeing early days of some FPI flow reversals to emerging markets. Early days, but I think between now and April, we will see a strong bottom formation in a market that has been, I think has been terribly oversold and very, very aggressive selling by FPIs. I think the valuations have settled down. I don't think they are as frothy as they were. We have seen volumes being very low over the last 3, 4 trading sessions, because of which stock prices have been fairly volatile. So I think we are, as near the bottom as one can be, though it's difficult to call. But I think this kind of aggressive selling followed by poor volumes typically means that the markets are bottoming out. There are no buyers, no sellers. So as liquidity comes back to the market, I think you will see the market stabilizing between now and April.
So at least that is positive and optimistic going ahead. Thanks for that view coming in. Abhay, this is Snehi also joining in the conversation. Amid a market like this, where are you seeing some early opportunities, if any early green shoots or pockets of value, if you're observing?
So, fundamentally, what we keep doing is that we keep doing channel checks with our, network to understand how the domestic consumption is panning out. In Around the festive season last year, we saw the consumption fall off the cliff because of a couple of reasons. One, the interest rates were high, EMIs cost had gone up, the taxes were high, and overall inflation levels were high. And that led to very high channel inventories across product categories like autos. Even in real estate, we saw inventory buildup. We saw inventory in channels in stuff like paint, polish, tiles, plywood. And then in January, what we saw that they were deep discounting to get rid of that inventory. And where we are now is that the channel inventories are actually quite lean. The auto sales haven't really picked up dramatically, but they are not as bad as they were post-festive season. So, with interest rates coming down, tax cuts being announced in the budget, there is more consumer, behavior is kind of early stages of changing positively. So I think we are seeing green shoots on the consumption side, discretionary consumption. And I think if that happens, the sectors that will benefit immediately are banking and financial services. We saw a lot of provisioning last quarter by small banks because of lower collections. But these lower collections were not from people who are habitual defaulters. They were from people who just did not have the cash to pay. So I think some of that money has started to come back. So I think you will see some provision write backs because these were not actual losses. So I think in terms of sector, I would say domestic discretionary consumption sector after the beatdown looks pretty interesting. Banks, especially small banks and NBFCs, where people have thrown in the towel expecting massive write-downs. I think that will make a comeback. So these are the two sectors that we are betting on actually now.
Talk to us about the EMS side, because what we have seen is that there has been some concerns regarding the high valuations. What has been your reading on this one? Believe that you have made some of the recent additions into this particular sector. Help us with your rationale.
So EMS is a space we are very positive on. I think this tariff pressure, if I may call it that, is adding to the government's plan of localizing manufacturing of electronic components which do not need to be imported. I mean, these are not very high precision items that we cannot make in India. So through PLI schemes, the government has been very focused on over the last 5 years of supporting domestic manufacturing of components across the space. You have companies that are catering to consumer electronics like TV, fridge, mobile phones. You have defense equipment, you have networking equipment, computer equipment, railways, railway equipment. I think so. A lot of companies have benefited from that PLI and now becoming large scale manufacturers, very competitive now, slowly at global scale also. So this is a very high growth sector, but in the what we saw is that there was a lot of bullishness which took the valuations to what I would say were frothy levels. A lot of that has corrected. Now we have seen 30-40% stock price correction, and I think this is the growth sector one can easily bet on. The valuations will always be high on a relative basis, but if you look at companies like, these are not buy recommendations, but companies like Keynes, Sirma, Amber, Dixon, I think these are the companies which are right at the forefront across product categories. So I think with government support and a lot of support from the domestic consumers, I think this is like a decade-long story on the EMS side.
Okay, and Abhay, also before we let you go, I'm just taking a look at your portfolio. Some of the deletions include big names like Grasim, Hindalco, Reliance and UPL. Help us understand the rationale behind this. We've been seeing positive news coming in for Grasim yesterday. If you take a look at Hindalco also, I think over the last 1 month or so, it's given a decent 10% return. What's the rationale behind getting all of these stocks out of the portfolio? Because Reliance, I understand the kind of correction that we've seen recently, but help me understand the rationale behind Grasim and companies like Hindalco and UPL.
The reason was that some of these stories have already played out, and these are not very high growth stories. So what I would call them as defensive names. And for us, it was tactically rebalancing our model portfolio to get out of some of the low growth, large cap names, and actually benefit from this sharp correction to get into some high growth, small and mid cap names. So I think it's just for that reason. There is nothing negative that we have against these companies. The reason to exit was not that we don't expect these companies to do well. It was just that on a relative basis, we see better opportunities during this sharp correction. And as fund managers, our objective is to take long-term view, 3 to 5 year perspective. And there we see better growth stories at valuations that have looking far reasonable right now. So that is the only reason. I mean, there is no other reason than that.
All right, Abhay, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us.
If you like this video, then like, share and subscribe to ET Now.